In this video, we're going to be talking about inflation, which is something quite different to what we normally talk about here on the Money Cog, where we focus more on stocks, how they make money, focusing more on the qualitative factors that make companies great and why you should invest and why you shouldn't invest. And we also have a great website where we do premium research on those companies. So if you want to stay tuned and listen to more sort of content around stocks, or you want to look at more around industries, because we're going to be looking at industries as well in future videos, give us a subscribe down below and like this video if you want to give the YouTube algorithm a chance to share our great content with others. We're looking at doing things a bit differently here. We like to look at things from a more bottom-up approach, but today we're doing something a bit different. So I'm joined now with my co-founder, Zaven. So he's hidden. Is he here? Oh, there he is.
Hello.
So we're talking about something a bit different today, because we're talking about inflation and macroeconomics and things we don't really like to talk about here because, well, we don't think it's that valuable, do we? But the point is everyone's talking about it. So we want all the investors to know, well, why is it important? Why isn't it important? And what does it really mean for stocks, companies, and investments in general? So the topic is inflation. And if you live in the UK, you've probably seen all these scary numbers saying inflation is going to hit 18%, 20%. And probably most of you probably know what that means. It just means that the value of a pound next year is going to be worth a lot, 20% or 80% less than it is today. So what you can buy with a pound essentially can be worth less. But maybe, Zaven, why don't we go into it? Because it's everywhere. It's not just hitting the UK.
Yeah.
It's hitting our US compatriots who watch this channel where we talk about US stocks as well, and it's hitting them as well. So maybe if you want to go a bit more into detail about why it's important to even look at it or not.
So inflation it's obviously a very real cost that is starting to have an impact on the economy, especially when it comes to consumers. As long-term investors, honestly, it's really not as much of a big deal as a lot of people like to make it out to be. If you're a short-term trader, then yes, the volatility we're seeing obviously very important because they're focused on making various forms of trades, whether it's swing trading, momentum, etc., stuff like that. But for long-term investors, we care about the business. Inflation does have a tangible impact on businesses. But what we've seen time and time again is that the strong companies, which are the companies we like to invest in as long-term investors, it really doesn't matter all that much, mainly because companies are very good at adapting to situations. So let's start with the horrible stuff. Inflation is going up quite a bit, a lot higher than what a lot of people were expecting maybe a year ago. I think the Bank of England recently gave their forecast. They're predicting it's going to hit something like 13% by the end of the year. Others are saying it's going to get a lot higher. I will note that the Bank of England has a pretty terrible track record of accurately predicting these things. So who knows what it will actually be? Time will tell what's going on. And I think the common consensus here for the UK, at least, is that things won't begin to normalize until as late as 2024, which is just like, oh, okay. Does that mean we've got 2 years of hell ahead in front of us? And in my opinion, no. And we're going to go into a bit more detail as to why that's the case. But yeah, in general, inflation, bad thing. But it... let me recount that. A small amount of inflation is actually good because it stimulates economic growth. This is why central banks are always targeting for around 2%, 2.5%. It gets consumers spending their money, that promotes business growth. As businesses grow, that means more jobs, and the whole thing sort of builds up over time. And that's what we've been seeing over the last 10 years since the financial crisis. As the money supply, if you like, has been slowly drip feeding into the economy, we've seen a tremendous decade of one of the longest bull markets in history. And towards around 2018 time, the central bank started saying they wanted to cool things down. In fact, the Federal Reserve tried raising interest rates in 2018 and immediately backtracked because the market was not happy about it.
Yeah, and I think now the Fed is trying to get a good record. It's getting a fairly bad rep in being able to sort of try and raise interest rates very quickly and very aggressively. And the reason you raise interest rates, of course, is so when inflation is high, one of the two central banks, whether it's the Federal Reserve in the US or Bank of England does, it raises interest rates. And the raising of interest rates obviously affects all borrowing because everything is based on those, the Fed funds rate, or in the UK, the Bank of England rate. And that affects things, that affects basically borrowers, your mortgages and all sorts of borrowing that goes on. So things become more expensive. suddenly borrowing becomes more expensive. So the idea is to contract the economy and things like that. So there's, we'll talk about it a bit. I think it kind of leads into my next question, which is how do we combat that investment? So I guess some of the fears that people have is that when you have inflation, what does that mean? And in terms of your investments, and I've alluded to that a bit, which is if you have, if the central bank tries to fight really high inflation with high interest rates, you can have what they call a hard landing, where they try and raise interest rates, but actually it has a negative effect and you have massive slowdown in growth and you lead to a recession. But how do we play that, or should we even be playing it? As you know, we like to focus on the Money Cog. For those of you who are new to the channel or watching this for the video first time, we just tend to look at companies, and you invest in great businesses over a very long time. It doesn't really matter. These factors kind of not neutralize, but kind of go out. They're not as
over the long term. It all balances out anyway. The companies, like you just said, in fact, because of inflation, we've got too much. The central banks are raising interest rates. If they do that too quickly, then that could trigger a recession, which is bad for everyone. Although I suppose it does fix the inflation problem. So, you know, glass half full, if you like. But that does raise the cost of debt. And as the cost of debt goes up, the cost of equity goes up. And it's all, you can go a bit in the weeds as to how that all influences. But it's one of the reasons why technology stocks in particular, even though they don't have, well, most of them don't have any debt on the balance sheet, they've been hit the hardest because they're so dependent on external capital. And that external capital usually comes from debt. It makes life a bit difficult, especially if you don't have any free cash flow to work with. So that it's understandable. And then when you have the added negative impact of a consumer spending slowdown, trying to secure growth in an inflationary environment with high interest rates is even more difficult. So suddenly the premiums tend to start evaporating and you see massive stock drops in relatively short space of time.
To add to that point, majority, when you look at GDP, and the formula for GDP, it's consumption plus government expenditure plus exports minus imports. But one of the biggest factors in the UK and the US, I think in the US, 70% of GDP is consumption, which is me and you buying things, which is what you alluded to, right? So suddenly high inflation, but then you've got the central banks increasing interest rates, then you can have a negative impact on spending. And like you said, on the one side, you've got tech stocks, which have had a re-rating because, you know, cost of capital is going down. And also a lot of companies are valued on DCFs, and then the discount rates go up. So expectations, and we like, it's not something that we talk about much on the Money Cog, because we look at what businesses are fundamentally worth and sort of the competitive advantages and other factors, but everything is priced in terms of expectations. So when you look at the stock market and stocks, it's being priced today on future expectations of what's going to happen, and what happens is what changes those expectations is what will drive future changes in stock prices. And you mentioned you know, not just the S&P's been down, Nasdaq's been down, you know, things have been hit pretty bad. So what about commodities? Everyone talks about gold. You know, gold is a great inflation. And why is that? Maybe
there is a reason why a lot of people are becoming proponents for gold these past few weeks. And that's unlike some cryptocurrencies out there that was supposedly a hedge against inflation. Gold is a hedge of inflation, or at least that's what the last 200-300 years worth of data would suggest. But I've got a chart here. Let me share my screen, because I think this will very quickly sort of demonstrate what's going on. So I've got a chart in front of me. This is the price of gold per ounce in pounds versus UK inflation. Gold is the yellow line, inflation is the black line. And this is going across the last 20 years. And we can see that there's a pretty strong correlation. When inflation goes up, the price of gold goes up. When inflation comes down, the price of gold goes down. But steadily it's been increasing. You know, it's going from the bottom left to the top right. So if you had bought gold in 2002, congratulations, and you held it all this time, you would have made a positive return, which is, you know, that's another sort of discussion. But the whole concept is because you're putting money into a commodity and the value of that commodity moves in line with inflation, you can pull your money out again at a later date at a higher price, which even though it's a positive return, when you take into account the effects of inflation, you're roughly left with the same amount of money you had before in terms of spending power. So when inflation is going up, people move their money into gold, the value of gold, the price of gold goes up, and that protects your wealth. But in terms of growing your wealth, then this is where things get a bit murky, and we can talk a little bit about why that's the case.
It's interesting. I mean, so when you look at this chart, what's interesting is it's look, I mean, in 2002, gold is what it looks like it's trading at £250.
Something like that, yeah.
But you look now, it's only at 1,500. I mean, just if you look at it from a 10x, or just where prices are and value, it's not a huge, like you say, wealth creation or value creation, because the difference is you're here, gold and everything is demand and supply. So inflation, people get worried about inflation, preservation of wealth, gold goes up, demand goes up. These are very demand and supply driven things. Gold moving up and down, I mean, guess the natural trend is it's going up. But in terms of an investment, which is going to give you a great accumulation of wealth, not really, because it's not a business which is generating great enormous amounts of value. It's all being driven by demand and supply factors. It's commodity.
Yeah.
And at the end of the day, it's me and you can go and mine gold, and there you go, it's gold. it's the price of the market.
Well, I don't think we could go ahead and mine it, just because we don't have the expertise of all the sort of engineering on that front. But you could just buy a gold miner in that sense. But yeah, there are some people who disagree with the whole statement that gold is not a good long-term investment, and there is good reason for that. So I would just like to, I've got another chart here which I'd like to just show. And this is a comparison of the performance of gold versus stocks. So the red line is the S&P 500, the blue line is the Dow Jones, the yellow line is gold, and the gray line is silver. And we can see over the last 10 years, gold is basically not moved. It's pretty much flat. In the meantime, stocks have gone up nearly 180%. And if you invested in silver back in 2012, then you've actually lost money. So that's not good. And the whole point of doing this is that gold, yes, it's a good inflation hedge, but if your financial goal is to grow wealth, to build capital, as opposed to protect it, then investing in gold for long term, not really the way you'd want to go based off the data we have available to us. Now, this is only a 10-year perspective. What if we go back further? I've got another chart down below. This is the same chart, but on a 30-year horizon. So this is going back all the way to 1992. And here we can see the performance of gold, again, has actually done a lot better. It's up nearly 400% over the last 30 years, but stocks are closer to 850%. It's double. And then there's a very simple reason for that. Businesses make money. Gold is just sort of there. It's a thing. It doesn't do anything. It doesn't generate cash flows. It doesn't provide jobs. It doesn't grow the economy. It's just a means of storing wealth. And that is a useful tool. If you are a multi-billionaire and you need to put more money somewhere, it doesn't have to be that. If you're relatively well off and you want to just protect your assets you have, then yes, gold is a fine instrument to do that, especially during inflationary periods.
So that's an interesting point. I mean, I'd like to add something around utility. And actually, I mean, we talk about a lot of kind of how you construct your portfolio, what your objectives are, all in the investment guide, which we'll put a link in the description below. So those who are interested in learning more about portfolio construction, and that's probably one of the fundamental keys to success, is how you construct your portfolios and your objectives, etc. You can learn a bit more about that in our investment guide below. But back to this point, and you mentioned the massive divergences in value. I guess one of the ways I like to explain it is about utility. So when you look at things in terms of what is the utility of gold, you just mentioned it. It's just a preserver of wealth, really, and people use it for necklaces or
it's a pretty piece of metal.
Yeah, and in certain cultures, it's used for jewelry and things like that. But yeah, that's one of the demands. But that cultural thing changes, and with the rise of Bitcoin and cryptocurrency, people think, well, it's much easier
They think it's the new digital gold, despite there being next to no evidence of that. But time will tell. It's too early. Yeah, it's too early to determine what role Bitcoin will have in terms of a store of value, just because it's only been around for about a decade, which really isn't a long time. By comparison, gold has been used as a form of currency or store of value for nearly 2,000 years. So
no, exactly. No, that makes sense. And then when you look at companies, I was watching a video today earlier about utility and zero-sum games and positive games, where when you invest in a company, you're playing a positive sum game of value, because a company can just create value, through if you give a company $1,000 worth of, let's say, company raises money or floats on the stock market, and suddenly it gets an injection of cash flow because it's raised money on the stock market. That company, with that 5 billion it's raised through the capital raise, can actually do a lot with that and probably create value worth 15 billion. And that's what it's all about. It's creating future value.
It creates a product or service that is high in demand, or creates the demand if it's a new industry, that gets consumers to start spending, or other businesses, depending on which side it's facing, business to business or business to consumer, or the other variants of that. And as a result, that promotes economic growth. Economic growth improves, there's more jobs to be created, and the whole sort of thing. Everyone ends up more wealthy. And that's capitalism in a nutshell, really. I mean, it's far from a perfect system, but in terms of being able to build wealth, and create monetary value, actual tangible value, then yes, that's sort of what stocks can provide that gold can't, really. And that's fine. Gold wasn't designed for that. I say designed. That's not how we use it. And that's probably a better way of saying it.
And I think just to say for those, we're not saying that inflation or these macroeconomic factors aren't bad as a whole in terms of the economy. Like, they will have impacts. But when it comes to you investing in stocks or long-term stock investments, they shouldn't matter, right? They shouldn't really matter, because when you're looking at companies, you're looking at, first of all, I mean, the way, those who are interested, they can go to the link below and find a bit more about how we look at companies on the Money Cog and in the link below. But we tend to look at companies around, okay, what's the business model? How does this company make money, right? And there's various different business models. And then, we look at the fundamentals. But inflation as a whole, short term, might have impacts. The cost of materials and the cost of labor, the cost of items goes up.
This is where we have to sort of say it with a caveat. In terms of long term, it doesn't really matter, but we're making the fundamental assumption that the business is sound. There are a lot of companies out there which have seen their stock prices absolutely plummet in the last 6 months or 8 months. As a result of a very weak financial position. Over the last 10 years, debt has been very cheap because interest rates have basically been 0%. So a lot of companies, in the pursuit of growth, have loaded up the balance sheet with debt. And it was completely fine because they were generating enough operating profit to cover the interest expense, and it allowed them to expand and grow really quickly. But if the companies that fail to build value, because there's two pillars, you've got growth on one hand and you've got value on the other. And a lot of people have forgotten about value in recent years. If you're not generating positive cash flows from your operations, but you keep adding more and more debt, then you essentially start over leveraging yourself. Now that interest rates are going up, if you are a company which has an enormous pile of debt to service, and it's all based on variable rate loans, which a lot of them are to a certain extent, then you are in trouble. There is a genuine reason to concern, because not only are you struggling from the consumer spending slowdown, you now have to deal with even more margin pressure from your debt interest going up.
You're right.
And this is, I think, a prime candidate of a company that's just gone through this or is suffering right now is probably Cineworld, who is, we don't know what's going to happen there, but they're in the process of considering bankruptcy because of what they've done over the years from poor capital allocation.
And actually, Cineworld is a really good example of where, it's maybe it's a trader's game, right? People might you say, well, it's gone up from, trading at 1 or 2, it's trading at 1 or 2 cents, or a p, and that's gone up to 7, and it's pretty. Yeah. It's one of those things which is it's not really something we really need to.
As maybe there's a long-term play there, but unless you're some like a forensic accountant who can figure out what is the state of their books, which I don't even think you'd be able to do unless you had access to more information that's publicly available.
And that's what I was saying. The same thing to my friend. I was like, well, to be honest with you, all it is just a punt and a gamble, really, because you're assuming that you have better information than everybody else, that they're going to be able to restructure things, and that's all just not based on any sound reasoning. It's just based on the gamble and a punt that this is why it's not really a sound investment.
Well, we've seen a lot of recently. People seem to be very eager to make these sort of punts. If we look at some of the biotech stocks of the last 2 years, even if it's a phase 1 trial, pre-revenue, doesn't, despite the fact there's like a 90% chance of failing phase 1 trials in general and the billions of dollars it costs to actually bring a drug to market, people are more than happy to throw money at anything that has a pulse because it might go to the moon. It's just, I think a lot of excitement and hype has been built into the stock market in recent years, especially with you have a lot of spare capital from the stimulus checks. And people are starting to realize that, hold on a minute, earnings need to materialize, especially now that external capital is evaporating. We've seen a lot of the venture capital funds in Silicon Valley. They've just been axing projects. They've canceling Series A, Series Bs, all this sort of stuff. It's going out the window because they're in full conservative mode. They're only going to focus on the projects they believe have the most likelihood of success. And that typically means the ones which are further in the funding process and actually have a proven product. It's not a good. The high inflation and rising interest rates doesn't make for the ideal environment of an unprofitable business without a clear path to profitability. Now, with some of the tech stocks, most of them are unprofitable. There are some, obviously there's companies that are profitable now. A lot of them have been hit hard. Now, that doesn't mean all of them are screwed, because in case anyone hasn't been paying attention, in 2021, some of these valuations reached really high levels and management wasn't idle. They were issuing shares at high price. And there's a reason for that. It's because it was efficient to do so. So a lot of these now have billions of dollars of cash on their balance sheet that provides so much flexibility that providing this current economic situation doesn't transform into something more dire. I know there's a lot of fears of stagflation with some similarities to the 1970s floating around, and we can talk a bit about that in a moment if you like. So long as it doesn't get worse, they should have enough capital to see them through the storm. And when you layer on top of that the planned sort of cuts, we've seen a lot of sort of jobs being cut and, to try and bring down spending, bring down the cash burn. The odds are that the top quality businesses, which weren't necessarily geared for profitability beforehand, they were focused on growth. Now that more people are focusing on earnings again, it's likely some of these could turn profitable within the next 1 or 2 years, and then they're in the clear to some extent.
Yeah, and on the back of the point regarding the top companies which are profitable, you're also starting to see M&A activity in the top companies that are profitable and have a lot of cash on their balance sheet, because the ones that aren't doing that well but can, you know, when we talk about restructuring, or they've got a great value proposition, but has been badly run.
This is something I want to watch, actually. I can guarantee over the next 6 months, a lot of companies are going to start adopting poison pills because they don't want to be targeted by corporate raiders.
And poison pill for those is a strategy which companies do when someone's coming to sort of come in and purchase them, right? They try to avoid.
It's essentially Twitter recently did this with a whole fiasco with Elon Musk before they decided to accept his offer and before he decided he didn't want to buy anything. That's a whole fiasco in itself. But essentially the way it works is when someone starts buying a huge chunk of shares, you can introduce a poison pill that means if this person owns more than a certain percentage, in Twitter's case it was 15%, then shares would just be issued to every other shareholder in the company, which means they could never get above that threshold. It would destroy your stock price, but it means it would essentially protect you from being taken over in such when you don't want to be, basically. It forces the potential acquirer to come to the board of directors and actually negotiate a deal to try and get the same terms. Now with share prices trading so low and a lot of M&A firms having a lot of capital at hand, they're seeing this as the perfect sort of buying opportunity, which is basically what it is. I mean, as long-term investors, we should be looking. We've now just gone through. There are plenty of top-tier companies. For example, Apple. It's one of the biggest technology companies in the world. Its stock price, I think, is down like 30% since the start of the year. Do we think Apple is going bankrupt? It's just. Yeah. This is not a recommendation to buy Apple shares, by the way. There's a lot more research that needs to go into it before making any form of decision. But is this sort of mindset where you see these fantastic companies being sold off on all the sort of chaos and the fear and emotion and whatnot, that you can't help but think, have people overreacted? And to some extent, I think that is true. There's definitely cases where stocks have fallen for a very good reason. But there's also cases where stocks have fallen because people are panicking and now buying opportunities have emerged. But being able to recognize those buying opportunities is difficult because we don't know what's going to happen in the next few months. In the short term, stock prices are driven by mood and momentum. It's not, long term, it's driven by the underlying value of the company, but in the short term, it's all sort of irrational human expectations of what's going on. And even if there's good news coming out of a company, the stock could still plummet. And it makes it quite a scary time to invest. But this is where something like dollar cost averaging is a really handy tool, where instead of investing all your money in a lump sum, you spread your investments over a period of time. That way, if you want to invest in a company and the share price continues to fall, you can buy it again, assuming the whatever it's called, the sort of opinion about it hasn't changed. The long-term capabilities of the company hasn't become compromised. You can buy it again at a lower price and bring your average purchase price down.
Yeah, no, that makes sense. And what's interesting is another point to mention is that that's a good strategy, because when you look at things like, people talking about cost of living or their inflation and their wages being worth less, but if you've got an investment portfolio and you've invested, your investment portfolio over a long period of time is likely to be higher than inflation. So if you looked at real terms, which is your what the growth of those stocks did take away inflation, you'd have a positive return. But if you look at things like property, which everyone loves, which I think is not really a great of an investment, especially in the UK, because I think things are overpriced, is London, and I think London house prices are down 10%, the rest of the UK is 5%, but it's down a lot more in real terms because of inflation. But the point being that you want to invest in things where you get a higher return over your invested capital, and that's something we look at. I mean, so it's something also an interesting measure you look at when you're looking at business anyway, return on capital employed, which we'll do another video on for those that are interested. I know we've talked quite a bit, and maybe I'm not sure if people have reached the end of this video. So maybe some last thoughts on inflation, Zaven?
People need to stop getting their knickers in a twist. No, there is obviously, you can't just make sort of blanket statements like that, because there are situations where inflation is having a real impact on people. As here in the UK, we've got a cost of energy crisis, mainly because we're highly dependent on gas to power. I think 60% of electricity comes from gas turbines, and the price of gas has gone through the roof. So if that starts to reverse, then it wouldn't surprise me if inflation starts to cool down rapidly over here. But as investors, as unpleasant as it is to go through a bear market and to see stocks collapse, you only lock in your losses if you sell your position. And I think that's something to remember. The idea of selling your stocks now to buy gold, in my opinion, is a bad one, in the sense that the actual price of gold has already factored in the effects of inflation. So unless inflation gets even worse, then gold is unlikely to continue rising. So if you believe inflation is going to go up, then yeah, gold could be fine. But at what stage do you pull your money out? I don't know how to time the market, and most people don't. I think there's probably a handful of traders who have the necessary data that they've spent hundreds of thousands of dollars accessing to try and make these predictions. And even with all that, they end up getting it wrong most of the time. So focus on the long term. Remember to always invest in solid businesses, actual companies doing something, creating value. They have the cash flows to go through it. And while it's going to be a sort of volatile couple of months, eventually it comes to an end. If you look back throughout history, and I know history is not an indicator of future performance by any means, but the stock market has a 100% track record of recovering in the long term. Every time, even after the Great Depression, even after the financial crisis where we saw the entire global economy shut down, it recovers. So it's just sort of take a deep breath. Yes, it's uncomfortable and it's not fun, but it'll eventually end. And
it goes back to the point, which we said. I mean, ultimately, companies provide a value. Companies sell goods and services of which there is a demand for, and companies which don't have strong moats or their business models are flawed, which we look at, won't survive. So if you are thinking of recession, and we talk about this, you want to look at companies where they can survive, whether that's through financial stress on their financial health, strong balance sheets that can survive a recession, and can get through that period. So that's the only downside. That's one of the things you'd look at, right, when you're going through a very difficult time. That is your portfolio. Can these companies survive through a very difficult period? Because
as a final point, these exact situations is why almost every financial advisor will say, do not invest money you need in the next 3 to 5 years. Is because the last position you want to find yourself in is to be literally like this, where your stocks are down because of external factors, even if the underlying business is still fantastic, and you are forced to sell because you cannot meet your living expenses. This is why we always sort of say, make sure you have cash on the side in case of emergencies.
Yeah.
And don't invest money that you need.
Exactly. And that's a fair point. And actually, whilst we said we don't do market timing or we don't do it, but a lot of what we do, the Money Cog, part of it is valuation and pricing, because the point is you don't want to invest in companies which are, sorry, my phone is ringing. Second. I'll call this person back. You don't want to invest in companies that I've lost my train of thought now. I think what I was I just alluded to the point being that okay, I don't remember the point, which is unusual for me. But I think maybe I think maybe what I was saying was you don't really want to be investing in businesses which are very expensive because the market timing. So if you invested maybe 6 months ago, you've now seen a massive 50% fall in your portfolio. But actually, if you looked at those companies,
painful.
If you look at some of our research, it's fairly priced. You would say, well, that company is maybe overvalued or undervalued.
This is we don't place too much emphasis on valuation because it is sort of a bit of, you're making an educated guess at the end of the day, but it does give you a nice sort of indicator as, wait a minute, is this stock trading at such a premium that makes absolutely no sense? And why is it at that stage? If it's based off a total addressable market that's set to explode by 40 times in the next 10 years, and it's going to be the next biggest thing, it's probably a worse sort of reason to invest in a company because no one's going to capture 100% of a total addressable market. It isn't going to happen. And yes, it's fun to look at those metrics. If your entire valuation is based off what you could do rather than what you have, then prepare to get absolutely hammered.
Exactly. All right, let's see. This was a really, really good conversation on inflation. We're going to do more of these videos. If you like this video, give us a like so we know as the sort of founders of the channel, we should do more content on this. Leave us a comment on the ideas you have for videos or things you want to learn more about. But hopefully you guys enjoyed it if you made it to the end. And if you made it to the end, we might give you a discount on premium, shall we?
Yeah, go on.
So
I think everyone needs a bit of information these days.
So if you go in the description below, we'll give you a discount code for our premium service. Thank you, Zaven.
Yeah. Thank you very much, Imran. Until next time.